Welcome back to day 9 of our 30-day trading podcast journey. Today we are going to tackle a topic that affects all traders, no matter their experience level, trading during major news events. Whether it's an earning report, economic data, or an unexpected global news, these events can cause massive volatility in the market. If you know how to handle that volatility, you can find some great trading opportunities. But if you are not prepared, it can also lead to big losses. So today, we are going to dive into how you can navigate market volatility during news events and what strategies can help you come out on top. Let's get into it. Understanding the market volatility during news events. So, when the major economic data is released, like the inflation numbers, interest rate announcements, or job reports, the market can react in an unpredictable ways. The same thing happens when companies release their quarterly earnings or when unexpected global news hits like political instability or natural disasters. These events can cause sharp price swings as traders react to new information, often leading to extreme volatility in a short period of time. Prices can jump or drop within minutes and spreads widen as liquidity dries up. This can be both a risky and an opportunity. As a trader, it is essential to understand that news-based volatility is different from regular market movements. It can create a lot of uncertainty, but with the right approach, you can manage that volatility and even take profit from it. Not all news events are created equal. Some have a massive impact on the market, while some others may create a small ripple. Here are the main types of news events that you should be aware of as a trader. Economic data. This include events like non-farm payrolls, interest rate decisions by central banks, inflation reports, and GDP numbers. Economic data tends to have a direct impact on currency market and stock indices. So it's crucial to know when these reports are coming out. Earning reports. If you trade stocks, earnings season is a critical time. Companies release their quarterly earnings reports, and this can lead to a huge price movements, especially if the results are much better or worse than expected. Earnings report also offer insights into the company's outlook, which can affect the stock price moving forward. Geopolitical events. These are the more unpredictable news events like elections, wars, or natural disasters. Geopolitical events can cause major market shifts, and because they are often unanticipated, they can create significant volatility in the market. Unexpected news. Sometimes news that are not tied to a scheduled event can cause major impact reactions. For example, unexpected company scandals, regulatory changes, or global health crisis like COVID-19. You can't predict these events, but you can prepare by having a plan in place. So, how do you trade during these volatile moments without getting caught off guard? Here are some strategies to consider. Stay out of the market. Believe it or not, one of the best strategies during major news events is to simply stay out of the market. This extreme volatility and unpredictable price movements can make it very difficult to execute trades effectively. If you are not confident in how the market will react, sometimes the safest move is no move at all. Use a news calendar. One of the best tools that you can have is a news calendar. Websites like Forex Factory or TradingView provide the economic calendars that show when major events are happening. By keeping an eye on this, you can prepare in advance and avoid trading during high risk times if you choose to. Trade the reaction, not the event. A common mistake traders make is trying to predict the outcome of a news event and place a trade beforehand. Instead of guessing it, it's often better to wait for the market's initial reaction to the news and then trade based on how the market is behaving afterward. This way, you can make the decisions based on the actual data instead of speculation. Use tight risk management. Because news events can create such unpredictable moments, it is essential to use tight stop losses and small position sizes when trading during these times. This minimizes your risk in case the market goes in the opposite direction of your trade. Remember, risk management is your best friend when trading in the volatile market. Watch for the false breakouts. Volatility can create or lead to false breakouts where the price quickly moves past a key level only to reverse back just as fast. If you are trading breakouts during news events, wait for the confirmation before jumping in. This can help you avoid getting caught in a trap. Managing emotions during volatility. Volatile markets can trigger a lot of emotional reactions, whether it's fear, excitement, or greed. These emotions can cause you to make impulsive decisions like chasing trades or widening your stop loss just to stay in a position. Here's how you can manage your emotions. Stay calm and focused. It's easy to get overwhelmed when prices are moving rapidly. Take a few deep breaths and remind yourself that you don't have to trade every news event. Staying calm and focused will help you make rational decisions. Stick to your plan. Before the news event hits, have a clear plan for how you will approach it. Will you stay out of the market? Will you trade after the initial reaction? Whatever your trading plan is, stick to it. Emotional decisions in volatile markets rarely leads to the good outcomes. Accept uncertainty. Remember, you cannot control the market and you cannot predict how it will react to every news event. Accept that there is always uncertainty and that's okay, fine. The goal is to minimize risk, not to predict every move perfectly. There are times when it is best to avoid trading news events altogether. Here are some situations when you might want to sit on the sidelines. If you are a beginner, if you are still new to trading, it's best to avoid trading during major events until you gain more experience. The volatility can be difficult to manage and it's easy to get overwhelmed. If you don't underestimate or understand the impact, don't trade news events if you don't fully understand how they might impact the route. It's better to study and learn first rather than diving in unprepared. If you are emotionally involved, if you feel overly anxious, fearful, or excited about an oncoming or upcoming news event, that's a sign you might not be in the best emotional state to trade. Trading requires a clear and calm mindset. And that's a wrap up for day 9. We have covered a lot today about the trading news events and how to handle that volatility that comes with it. The key takeaway is that while news events can create big opportunities, they also come with big risks. If you are prepared, have a plan, and keep your emotions in check, you can navigate these events more effectively. Tomorrow we'll be shifting gears to talk about the role of trading mentors and communities. How connecting with others in the trading world can accelerate your growth and help you stay on track. It's going to be a great episode, so don't miss it. As always, thanks for tuning in. If you are enjoying this podcast journey, don't forget to subscribe and share it with your friends. Until next time, stay smart and trade wisely. Thank you, everyone.